Intermediate Accounting, Chapter 8, Inventory. Chapter 8, Inventory, 1 of 2. After studying this chapter, you should be able to 1. Understand inventory from a business perspective. 2. Identify which inventory items should be included in ending inventory. 3. Identify the effects of inventory errors on the financial statements and adjust for them. 4. Determine the components of inventory cost. 5. Distinguish between perpetual and periodic inventory systems and account for them. 6. Identify and apply GAAP cost formula options and indicate when each cost formula is appropriate. 7. Explain why inventory is measured at the lower of cost and net realizable value and apply the lower of cost and net realizable value principle. Chapter 8, Inventory, 2 of 2. 8. Identify inventories that are or may be valued at amounts other than the lower of cost and net realizable value. 9. Apply the gross profit method of estimating inventory. 10. Identify how inventory should be presented, disclosed, and analyzed. 11. Identify differences in accounting between IFRS and ASPE and what changes are expected in the near future. Inventory. Understanding inventory. What types of companies have inventory? Inventory categories. Inventory planning and control. Information for decision making. Recognition. Accounting definition of inventory. Goods included in inventory. Ending inventory misstated. Purchases and inventory misstated. Measurement. Measurement of inventory, costs included. Perpetual and periodic systems. Supplementary system quantities only. Measurement and cost formulas. Choice of cost formula. What is net realizable value? The lower of cost and net realizable value principle. Inventories measured at net realizable value and at fair value less costs to sell. Measuring inventory using estimates. Presentation, disclosure, and analysis. Presentation and disclosure of inventories. Analysis. IFRS ASPE comparison. Comparison of IFRS and ASPE. Looking ahead. Understanding inventory. What types of companies have inventories? Retailers and wholesalers. Purchase merchandise in a form ready to sell. Unsold units on hand are called merchandise inventory. Manufacturing companies have inventories in various states of completion. Raw materials, goods and materials that are on hand haven't gone into production. Work in process, cost of raw material, direct labor, and manufacturing overhead on products that have been started into production but are not completed. Finished goods, cost of goods completed but not sold. Inventory planning and control. How much, what types of inventory should be on hand? Sufficient quantities to avoid running out of stock. Wide variety to provide greatest selection. How does a company control inventory costs? Wide variety leads to excessive carrying costs, investment, storage, insurance, obsolescence, risk of theft, damage. Low inventory levels, stockouts, lost sales, unhappy customers. Carefully monitor inventory levels. Information for decision making. What types of information do external users need? Existence of different types of inventories. How management is controlling and managing. How the inventory has been measured. Cost of goods sold. Beginning inventory plus goods purchased or manufactured during the year minus your ending inventory. Cost of ending inventory. Physical goods to be included. Items to be included in the product cost. Cost formula. Impairment in value. Definition of inventory. CPA Handbook Section 3031 under ASPE or IAS 2 under IFRS. Inventories are assets. A. held for sale in the ordinary course of business, finished goods. B, in the process of production for such sale, work in process. Or C, in the form of materials or supplies to be consumed in the production process or in the rendering of services, raw materials. As assets, inventories represent a future benefit over which the entity has control or access to. The purchase is the opposite side of a sales transaction. The purchase gives rise to the recognition as an asset. Inventory is recognized when the risks and rewards of ownership are passed to the purchaser. Control passes to the purchaser. Goods included in inventory. Legal title and possession signal the passing of control. Legal title allows the owner to sell or pledge the inventory. Possession allows the owner to use the inventory. With inventory purchases, sometimes legal title and possession do not happen at the same time. Purchases are usually recognized when goods are received. Exceptions: goods in transit, consigned goods, repurchase agreements, and purchase commitments. When to recognize inventory, based on change in control and risks and rewards. Transaction: goods in transit shipped FOB, shipping point. Who has legal title? Purchaser. Who has possession? Shipping company. Have control, substantially all risks and rewards passed? Yes. Who recognizes inventory? Purchaser. Consignment sale. Who has legal title? Consignor. Who has possession? Consignee. Has control, substantially all risks and rewards passed? No. Who recognizes inventory? Consignor. Sale with buyback. Same goods, fixed buyback price that includes a charge for carrying costs. Who has legal title? Purchaser. Who has possession? Purchaser. Have control, substantially all risks and rewards passed? No, where it is essentially a financing transaction. Who recognizes inventory? Vendor. Sales with high rates of return, where returns estimable. Who has legal title? Purchaser. Who has possession? Purchaser. Have control, substantially all risks and rewards passed? Yes. Who recognizes inventory? Purchaser. Sales with delayed payment terms, where vendor retains title until consideration collected. Bad debts are estimable. Who has legal title? Vendor. Who has possession? Purchaser. Have control, substantially all risks and rewards passed? Yes. Who recognizes inventory? Purchaser. Purchase commitments, non-cancelable. Who has legal title? Vendor, assuming the inventory exists. Who has possession? Vendor, assuming the inventory exists. Have control, substantially all risks and rewards passed? No, but may have to accrue losses if onerous contract. Who recognizes inventory? Vendor, assuming the inventory exists. Flow of costs. Merchandising company. Merchandise inventory. Cost of goods purchased, cost of goods sold, flows to cost of goods sold. If you're a manufacturing company, you have raw materials, direct labor, manufacturing overhead. In your work in process, you have the direct materials and direct labor and applied overhead. Then you have your credit to cost of goods manufactured. That goes into finished goods as a debit, and then you credit your cost of goods sold. You credit finished goods and debit cost of goods sold once it's sold. Inventory errors. Ending inventory misstated, 1 of 2. Effects of omitting items from ending inventory. Statement of financial position, inventory, understated. Income statement, cost of goods sold, overstated. Retained earnings, understated on the statement of financial position, and on the income statement, the net income is understated. Working capital, current assets less current liabilities, is understated. And the current ratio, current assets divided by current liabilities, is understated. Example. Assume that the 2020 ending inventory of We Ltd. Is understated by $10,000 and that all other items are stated correctly. How does this misstatement affect net income over a 2-year period? Inventory errors, ending inventory misstated 2 of 2. So between 2020 and 2021, we have the incorrect recording, and then we have the correct recording. So what you'll end up seeing is that the 2-year total will be the same, but the ending inventory is understated by $10,000 in 2020, and it should be $30,000. Inventory errors, other types of errors. Not recording a purchase but counting it in inventory. Not recording a sale in the current period, although the items have been delivered. Failing to adjust inventory to the lower of cost and net realizable value. When an error from a prior period is corrected, it is accounted for as an adjustment to retained earnings. Full disclosure, a description of the error and a statement of the effect on the current and prior financial statements. Measurement of inventory, costs included, 1 of 6. Inventory cost includes all costs of purchase, costs of conversion, and other costs incurred in bringing the inventories to their present location and condition, IFRS and ASPE. These costs include actual cost of the product, transportation and handling costs, other direct costs of acquisition, such as taxes and duties. Period costs, selling, general, and administrative, are not inventoriable costs. Measurement of inventory, costs included, 2 of 6. Volume rebates, recorded as a reduction of purchase cost. Can be recognized before it is received if the rebate offered is non-discretionary. If it is probable the terms of the rebate will be met. If the amount can be reasonably estimated. The amount of receivable is proportional to the total rebate expected relative to the current levels. Example, rebate of 10 cents per unit if the purchase total exceeds 100,000 units. Expected volume for the year equals 110,000 units per year. Purchases to June 30th equals 60,000 units. Sales to June 30th equals 55,000 units. Journal entry on June 30th. Debit rebate receivable 60,000. Credit inventory 5,000 units unsold 500. Credit cost of goods sold 55,000 units 5,500. Measurement of inventory, costs included, 3 of 6. Product costs, directly connected with bringing goods to the place of business and converting them to a saleable condition. Asset retirement costs must be included under IFRS. Taxes, not including recoverable taxes like GST and HST. Conversion costs, direct labor, fixed production costs allocated based on normal production capacity. Buying costs, expenses of a purchasing department, insurance costs, in transit, handling costs, not ordinarily included, cost versus benefit basis. Measurement of inventory, costs included, 4 of 6. Borrowing costs, interest costs incurred to finance activities that help bring inventories to a condition and a place ready for sale. Under IFRS, interest costs on any items that take an extended time to produce or manufacture are product costs. Under IFRS, if financing relates to large quantities produced on a repetitive basis, companies have a choice. Under ASPE, companies have a choice, but if interest is capitalized, full disclosure is required. Measurement of inventory costs included 5 of 6. Standard costs. Predetermined unit costs based on costs of material, labor, and manufacturing overhead when the plant is operating at normal levels of efficiency and capacity. Variances occur when actual costs do not equal standard costs. Reporting inventories at standard cost is acceptable as long as the results approximate actual cost. Unallocated overheads are expensed as incurred. Measurement of inventory costs included 6 of 6. Service providers work in process. Personnel and related overhead costs on services started but not completed. Overhead is allocated similar to manufacturing environment. Work in process is measured at production cost. Basket purchases, goods with different characteristics purchased together for one single price. Reasonable practice is to allocate total cost among the units based on their relative sales values. Measurement of inventory, costs excluded from inventory, storage costs, unless part of the process. Abnormal spoilage or wastage of materials, labor, and other production costs. Interest costs when inventories are purchased on delayed payment terms. Period costs, selling expenses, general and administrative expenses. Measurement and inventory accounting systems. Level of inventory affects current assets, net income, retained earnings, and ratios used to evaluate management's performance. Companies need inventory systems that give accurate, up-to-date information to monitor waste, breakage, theft, improper data entries, failure to record requisitions, to avoid stockouts and overpurchasing, and prepare accounting data. 2 systems in use for maintaining accurate inventory records. The Perpetual System continuously tracks changes in the inventory account. The Periodic System updates inventory records in the ledger only periodically. Perpetual System provides a continuous record of the balances in both the inventory account and the cost of goods account. Purchases of inventory and cost of inventory sold are recorded directly in the inventory account as they occur. Cost of freight, purchase returns and allowances, and purchase discounts are all recorded in the inventory account. Cost of goods sold is debited and inventory is credited when inventory is sold. A subsidiary ledger is maintained for individual inventory items on hand. Cost-effective method because of the popularity and affordability of computerized software. Periodic system. Quantity of the ending inventory on hand is determined periodically, called taking a physical inventory. Cost of goods sold and inventory accounts are not kept up to date. Purchases are recorded in a purchases account. Purchase returns and allowances are tracked in a separate account. Using the inventory formula, cost of goods sold is determined at the end of the period after ending inventory has been counted and costed. Beginning inventory plus purchases minus ending inventory equals cost of goods sold. Comparing perpetual and periodic systems, 1 of 3. Fesmeyer Limited reports the following data. Beginning inventory, 100 units at $6. Purchases, 900 units at $6. Defective units returned to the supplier, 50 units at $6. Sales, 600 units at $12. And ending inventory, 350 units at $6. Prepare all journal entries under each system. Comparing perpetual and periodic systems, 2 of 3. Perpetual inventory system. Beginning inventory, 100 units at $6. The inventory account shows the inventory on hand at 600. Same with the periodic inventory system. The purchase 900 units at $6. The perpetual inventory system, you debit inventory 5,400, whereas under the periodic inventory system, you would debit the purchases account for 5,400. Under both systems, you would credit accounts payable for 5,400. When 500 defective units are returned, under both the perpetual inventory system and periodic inventory system, you would debit accounts payable for 300. But under the perpetual system, you would credit inventory for 300, whereas under the periodic inventory system, you would credit purchase returns and allowances. Comparing perpetual and periodic systems 3 of 3. Perpetual inventory system. Sale of 600 units. You would debit accounts receivable for 7,200 and you would credit sales revenue for 7,200. You'd make the same journal entry under the periodic inventory system. But under the perpetual inventory system, you would make the additional journal entry to remove the inventory from the account once it's sold. You debit cost of goods sold for 3,600 and credit inventory for 3,600, whereas there's no entry under periodic inventory system. The end of period entries for inventory accounts where the inventory is going to be 2,100. Under the perpetual inventory system, there's no entry necessary. The account inventory shows the ending balance of 2,100. But under the periodic inventory system, we will debit the purchase returns and allowances for 300. We would debit inventory for the 1,500. We would debit costs of goods sold for 3,600. And we would credit purchases for 5,400. Supplementary system quantities only. Sometimes a complete perpetual inventory, quantities and costs is not cost effective. A quantities only system provides detailed records of increases and decreases in quantities only, not dollar amounts. Outside the regular account recording, so a periodic system needed as well. Physical inventories. Companies take a physical inventory regardless of the system that they use. The count is compared with the detailed records for verification and internal controls. Physical inventory should be taken at year-end to report correct inventory values on the financial statements. Companies given 2 or 3 months leeway if proper internal controls are in place. Measurement and cost formulas 1 of 2. A cost formula is a method of assigning inventory costs incurred during the accounting period to inventory that is still on hand at the end of the period, ending inventory. Inventory that was sold during the period, cost of goods sold. Identifying the specific cost of each unit purchased and sold is usually too expensive. You need a simpler method. IFRS and ASPE recognize 3 acceptable cost formulas: specification, identification, weighted average cost, first in, first out, also known as FIFO. Another method, last in, first out, LIFO, is no longer allowed in Canada. Measurement and cost formulas 2 of 2. The following data will be used to demonstrate the 3 formulas recognized in Canada. So you have your beginning inventory, your purchases, your sales, and your ending inventory. This is for Colmart Inc. The cost of goods available for sale for the month is $43,800. That's the number of units times purchase price per unit. Specific identification 1 of 2. Each item purchased or manufactured is individually identified, required for goods that are not ordinarily interchangeable and that are produced and segregated for specific projects. Advantages: matches actual costs with revenue. Ending inventory reported at actual cost. Disadvantages: may be costly to implement and maintain. May lead to income manipulation. may be difficult to allocate certain costs, for example, storage and shipping, to specific inventory items. Specific identification 2 of 2. Example, ending inventory and cost of goods sold under specific identification. So the ending inventory is still going to be the same number of units, 6,000, but the total cost will be 26,680. Therefore, our cost of goods available for sale, which is our beginning inventory and purchases, is 43,800. When you take away the ending inventory of 26,680, you get cost of goods sold for 17,120. Weighted average cost, 1 of 2. Volume of goods acquired where each price is different. Justification for using weighted average cost formula. Costs assigned closely follows the actual physical flow. Simple to apply, objective, less subject to income manipulation. Ending inventory costs on the statement of financial position and costs of goods on income statement are both made up of average costs. Moving average cost formula refers to a weighted average method used with perpetual records, both units and dollars. A new average unit cost is calculated each time a purchase is made. Example, ending inventory and cost of goods sold under weighted average method. So you have the total goods available of 10,000 and the total cost of 43,800. So if you take the 43,800 and divide that by the number of units, 10,000, you get a weighted average cost per unit of 4.38. You multiply that by the 6,000 in ending inventory, and the cost of ending inventory now becomes 26280. So you have our cost of goods available for sale of 43800. You subtract your ending inventory of 26280, and that gives you cost of goods sold of 17520. Moving average cost. Example, ending inventory and cost of goods sold under moving average method. We start with our March 1st beginning inventory. Then you have your March 2nd purchase. You have your March 15th purchase. So before you make the sale, you have to go and add up your total balance in your inventory count. So that's your 34,300, your 7,900, and your 1,900. And you divide that by the number of units you have in your beginning inventory and your purchases before the sale. So that's the 500, 2,000, and 800. And that gives you a weighted average or moving average amount of 3.95. Then after your March 15th purchase, you're going to have a new moving average of 4.2875. And after your March 30th purchase, you're going to have a new moving average of 4.4417. First in, first out, FIFO, 1 of 3. Assigns costs based on the assumption that goods are used in the order they are purchased. The first items purchased are the first items used or sold. Ending inventory comes from the most recent purchases. Advantages. Attempts to approximate physical flow of goods. Ending inventory made up of most recent costs, therefore close to its replacement cost. Does not permit manipulation of income. Disadvantages. Current costs not matched to current revenues, as oldest costs of goods sold are used with current revenue. When prices are changing rapidly, gross profit and net income are distorted. First in, first out, FIFO, 2 of 3. Example, ending inventory and cost of goods sold under FIFO method periodic. So we still have our ending inventory of 6,000 and our total cost is 27,100. That's made up of our newest purchases, which is your March 30th of 2000 at 475, and then the remaining of your March 15th purchases, which is only 4,000 of the 6,000 at 440. So then we subtract the ending inventory from cost of goods available for sale, and that gives us our cost of goods sold of 16700. First in, first out, FIFO. Example, ending inventory and cost of goods sold under FIFO method perpetual. So even though we will do this every time we make a sale, you're actually going to end up with the same cost of goods sold and ending inventory as your FIFO method under the periodic method. So they'll be the same. Last in, first out, LIFO. Costs assigned based on the assumption that items sold will be items from the last purchase. No longer permitted under IFRS and ASPE. LIFO does not represent the actual flow of costs. Ending inventory made up of oldest costs, therefore not a close representation of the recent cost, can result in serious distortions of reported income with price fluctuations. It's never allowed by CRA for income tax purposes. It's permitted under US GAAP and allowed for tax purposes under the US tax rules. Choice of cost formula. Accounting standards limit the choice of cost formula. Specific identification is required when goods are not normally interchangeable. Companies must apply the same cost formula to all inventories of a similar nature and use. Should choose the best method that 1. Corresponds and closely as possible to the physical flow of goods, 2. Reports inventory cost at its most recent cost, 3. Uses the same method for all inventory assets with similar characteristics. Method chosen can impact the amount of income reported and the amount of income tax paid. Measurement and the lower of cost and net realizable value principle. Cost is not appropriate if the asset's value, its ability to generate net cash flows, is less than its carrying amount. So just remember, this is done after we choose our inventory method, perpetual periodic. Then we apply the cost method, which was specific unit, weighted average, or FIFO. And now we do a revaluation to lower of cost and net realizable value. There is an assumption that the current assets can be converted into at least as much cash as the amount reported on the statement of financial position. A loss of utility should be matched with current revenues, the period in which the loss occurs, not in the period when the inventory is sold. Under both IFRS and ASPE, market is strictly defined as net realizable value. Net realizable value is an estimate that changes over time because inventory may deteriorate or become obsolete with time. Selling prices fluctuate with changes in supply and demand. Substitute values become available. Input costs to complete and sell, liquidate, or dispose of the product vary depending on the conditions and markets it is sold in. Need to determine the most likely net realizable value at the end of each accounting period given the specific circumstances. A new estimate is required for each set of financial statements. The lower of cost and net realizable value principle requires inventory to be valued at cost unless net realizable value is lower than cost. Application steps. 1. Determine the cost. 2. Calculate the net realizable value. 3. Compare the two. 4. Use the lower value to measure inventory for the statement of financial position. Application of the lower of cost and net realizable value principle 1 of 7. Applying LC and NRV to individual items. So we have spinach, carrots, cut beans, peas, and mixed vegetables. We have the cost and the net realizable value listed for each. So when we look at the spinach, cost is the lowest. When we look at the carrots and net realizable value, it's the same, so it doesn't matter. When we look at the cut beans, the net realizable value is the lowest. When we look at peas, the net realizable value is the lowest. And when we look at mixed vegetables, the net realizable value is the lowest. So when you add all of the lowest items up, you get a total of 384,000. Application of the LC and NRV principle 2 of 7. LC and NRV is usually applied to changes in value that occur in the normal course of business. Damaged or deteriorated items are reduced directly to NRV. Sometimes grouping items can affect the amount of income reported. Item by item is more conservative. Standards indicate that the rule should be applied on an item-by-item basis. Grouping is allowed if the products 1. Are closely related in terms of end use, 2. Are produced and marketed in the same geographical area, 3. Cannot be evaluated separately in a practical or reasonable way. Application of the lower of cost and net realizable value principle 3 of 7. So now we have our cost of total frozen and total canned, the amount of individual items, and the amount of related products. So our individual items are 384,000 and our related products are 394,000. So if we did this just on related products, doing frozen and canned instead of individual products like we did in the last example, we would pick the cost for total frozen, and then we would pick the net realizable value for total canned. Item by item is the more conservative approach because NRVs above cost are never included in the calculations. Example, cut beans. Application of the lower of cost and net realizable value principle 4 of 7. Two methods for recording inventory at lower of cost and net realizable value. One is the direct method. Records NRV directly into the inventory count if NRV is less than cost. Loss is buried in cost of goods sold. 2 is the indirect or allowance method. It keeps the inventory at cost and uses an allowance account to adjust inventory on the statement of financial position and a loss account shown on the income statement. Data for examples of both methods under periodic and perpetual inventory systems. So we have our inventory at the beginning of the period. At cost and net realizable value is the same. And then at the end of the period, at cost is 82,000 and net realizable value is 70,000. The journal entries using both methods with a periodic inventory system. So under the direct method, to transfer out beginning inventory balances, you debit cost of goods sold and you credit inventory. So that's the same under the allowance and direct method. Then to record ending inventory under direct method, you would debit inventory for 70,000 and credit cost of goods sold for 70,000. Under the allowance method, you would debit inventory for 82,000 and credit cost of goods sold for 82,000. And under the direct method, there's no write down to inventory to the net realizable value. But under the allowance method, you would record a debit to the loss on inventory due to decline in net realizable value, 12,000, and you would credit allowance to reduce inventory to net realizable value, 12,000. A debit to cost of goods sold is also acceptable. In either case, the debit would be presented as part of cost of goods sold. Journal entries using both methods with a perpetual inventory system. So under the direct method, to reduce inventory from cost to net realizable value, you would debit cost of goods sold for 12,000 and credit inventory for 12,000. Under the allowance method, You would debit loss on inventory due to decline in net realizable value for $12,000 and credit allowance to reduce inventory to net realizable value $12,000. Application of the lower of costs and net realizable value principle 7 of 7. Recording the loss in a separate account allows for clear disclosure, not hidden in costs of goods sold. Using an allowance account raises the issue of what to do with the balance the next period. If inventory is not sold, allowance should be retained to keep beginning inventory from being overstated. If inventory has been sold, allowance account should be cleared. You could leave the allowance on the books and adjust the balance to the correct amount at the end of the period. If the NRV rises, any previous loss can be recovered, but only up to the original cost. The allowance account cannot have a debit balance. Evaluation of the lower of costs and net realizable value model. Conceptual and practical deficiencies. Recognizing NRVs only when they are lower than cost leads to distortion of income. NRV is an estimate subject to manipulation. Advantage: inventory and income are not overstated. Exceptions to the lower of costs and net realizable value model 1 of 2. Inventory is measured at net realizable value because that is the amount that will be collected in cash. For inventory to be recorded above cost and for revenue to be recorded before a sale, the sale is assured or there is an active market and low risk of not selling. Can estimate the costs of disposal. Other situations where NRV can be used. Industry standard, agricultural produce, forest products, mineral products. Cost figures are too difficult to obtain. Byproducts where cost equals selling price, less cost to bring to market. Exceptions to lower of costs and net realizable value model 2 of 2. Inventories measured at fair value, less costs to sell. Inventories of commodity broker traders, grain and livestock futures, changes in the fair value, less cost to sell, are recognized in net income in the period of change. Biological assets and agricultural produce at point of harvest. Biological assets, living plants assets. Agricultural produce at point of or after harvest, products of the biological assets. Unrealized gains or losses included in the operations of related year. ASPE and IFRS, assets that produce inventory over a long period of time, for example grapevines, may be treated as property, plant, and equipment. IFRS require separate disclosure on statement of financial position. Measuring inventory using estimates. When taking a physical inventory is impossible or impractical. Estimation methods are used to approximate inventory on hand. Only an estimation is needed. Interim reports, reasonableness testing. Inventory has been destroyed, like in a fire or other catastrophe. Provide a rough check on the accuracy of a physical count. Two methods used for estimation is the gross profit method and the retail inventory method. Gross profit method 1 of 2, based on 3 premises. 1. Beginning inventory plus purchases equals the cost of goods available for sale. 2. Goods not in cost of goods sold must be in ending inventory. 3. Cost of goods available for sales minus estimated cost of goods sold equals estimate of ending inventory. Gross profit percentage of the selling price is favored over percentage of markup on cost. Most goods are stated on a retail basis, not cost. Perception, percentage of selling price lower than the percentage of cost. Gross profit based on selling price cannot be greater than 100%. Gross profit method 2 of 2. Example. Assume that a company has a beginning inventory of $60,000 and purchases of $200,000, both at cost. Sales at selling price amount to $280,000. The gross profit on the selling price is 30%. Estimate ending inventory. So you have your beginning inventory and your purchases at cost. Then you have your goods available for sale of $260. You have your sales at selling price at $280. You subtract your gross profit, which is 30%, $84, and that calculates your sales at cost and estimates cost of goods sold at $196. So your estimated inventory at cost is $64,000. Evaluation of the gross profit method. Disadvantages. 1. Provides an estimate only. 2. Uses past percentages. 3. A single gross profit rate may not be appropriate. Gross profit method not normally accepted for financial reporting purposes. A physical count is needed, but is used to estimate ending inventory for interim reporting and insurance purposes. Presentation and disclosure of inventories. General disclosures. 1. Measurement policy. 2. Total inventory as well as inventory by classification. 3. Amount of inventory recognized as expense on the income statement, usually reported as cost of goods sold, although some companies report expenses by nature, not function. 4. Any amount of inventory pledged as security for liabilities. Additional disclosures for inventory under IFRS. Carrying amount of inventory carried at fair value less cost to sell. Details of inventory write-downs and reversals of write-downs. Reconciliation of balances for biological assets. Agriculture produce at the point of harvest. Analysis. Financial ratios are useful for making decisions about how much and what type of inventory to carry, help investors assess management performance in controlling inventories. Inventory turnover ratio measures the number of times on average that inventory was sold during the period. Measures the liquidity of the investment in inventory. Inventory turnover equals cost of goods sold divided by average inventory. You can compare with industry average. Average days to sell inventory. 365 divided by the inventory turnover. Comparison of IFRS and ASPE 1 of 2. The CPA Canada Handbook, Part 2, Section 3031, Inventories, is converged with IAS 2 Inventories, so there are very few differences. Major differences between IFRS and ASPE relates to a specific international standard, IAS 41, covering biological assets and agricultural produce at the point of harvest. ASPE has no specific guidelines in this area. Comparison of IFRS and ASPE 2 of 2. Measurement. Asset retirement and decommissioning costs arising from the production activities. IFRS added to the cost of inventory. ASPE added to the carrying amount of property, plant, and equipment. Interest costs directly attributable to the acquisition, construction, or production of qualifying inventory. IFRS capitalized may be expense for inventory measured at fair value or inventory produced in large quantities on a repetitive basis. ASPE, choice of capitalizing interest or expensing the costs. Liability and loss for onerous contracts. IFRS must be recognized if the unavoidable costs exceed the benefits of the contract services. ASPE, no guidance provided. Biological assets and agricultural produce at point of harvest. IFRS, measured at fair value less cost to sell. ASPE, no guidance for prior to harvest, at after harvest carrying amount. The end.